Tonight's topic, we've got a special treat with Chris. Our topic is going to be New Frontiers in Online Private Equity and Venture Capital Investing. And so welcome. This is our FinTech, RealTech meetup group. We're a special interest group. So think of it as just like a subgroup under the Silicon Valley AAII. AAII stands for the American Association of Individual Investors, which is a large nonprofit. The charter is to provide education and information to investors so that they can be, better investors. And then specifically in our FinTech, RealTech, our purpose is to discuss current and emerging trends in finance and technology and that intersection and really how consumers can benefit. So I put up the links there so you could feel free to, the meetup.com is to keep abreast of our FinTech, RealTech events. And then of course, there's also the Silicon Valley AAII.com website where you could find other events that are upcoming. So as part of the main events that we always normally talk about, what are some of the main events for the AAII Silicon Valley that's coming up. So normally they take a summer break. So they're currently on summer break right now. And on September 19th, they're going to have an investment advisor by name of Christina Kirpina. She's going to discuss the economy, COVID-19, of course, the election, and then she's also going to talk about some emerging technologies and trends. And then October 10th and November 14th are some of those subsequent meetings. And then normally December is off for the main meeting. And then these are some of our other special interest groups. We have a financial planning interest group. They are on summer break, and so they might pick up in the fall. And then the other two that are currently running is the general investing discussion, which Lynn runs. Lynn is he's right there, Lynn Gillette.
Yep, I'm here.
So Lynn, that's on the 24th, right? August. I just want to.
Right, that's the fourth Monday of each month. So the 27th of this month is when we had our last meeting.
Okay.
And Roland, we just want to mention to all the members that this is being recorded.
Yes, this is recorded. Yep. So if you do not consent, you can log off right now. I'm kidding. So, but.
So I was wondering whether or not Simi is involved in this thing anymore. Have they stopped their meetings?
No, Simi is still running. Yeah, there's still meetings.
Right. They meet the first Thursday of the month, and they're online. And they don't take. I think they go year round. The group I run, we don't do December.
So, and then in August 27th, which is the Thursday in August, we're going to have another FinTech, RealTech meeting, the TBD on the topic. So let me introduce you to Chris Lustrino. Sorry for the misspelling there. But he is the founder and CEO of KingsCrowd. And prior to that, Chris founded the FinTech publication Simple Innovative Change, which was acquired. And then he was nominated FinTech Journalist of the Year by Lendit. And he spent 3 years as strategy consultant for LEK, and then followed by Freebird, another travel tech consultant. So he did sales and finance, and then part of the team that had raised 16 million to date. But I'm really excited about his talk about KingsCrowd because really it's an online platform that think of it like a Bloomberg, but for private equity and venture capital investing. So I meet with VCs, and a lot of times the VCs, how they make investments, it's somewhat subjective, right? I mean, everybody has their own methodology, but a lot of times, especially in the VC world, early stage investing, it's somewhat subjective. But Chris's platform is is it's an analytical platform that will make it much more data driven, and he wants to put that capability in the hands of retail investors, which is even better. So potentially some of you guys might do a better job of investing than even the VCs, right? So.
Well, thank you everyone for joining us here tonight, and thank you, Roland, for making this happen. I really appreciate having the opportunity to speak with all of you today, or I guess this evening. And I couldn't be more excited to be telling you about what we're up to at KingsCrowd. For those of you who don't know me, KingsCrowd, in one line, we're building the first independent rating analytics solution for the online private markets. To Roland's point, we're trying to build kind of a Bloomberg / Morningstar rating analytics solution for a brand new market that is just emerging. And I'll get into many of the details about what all of this means as I get into the slides. But before we get started, if there's one thing that I want you to take away from this presentation tonight and hope you walk away with is that we are entering a phase in time where we're seeing the birth of a multi-trillion-dollar investment market opportunity that literally didn't exist up until a few years ago, thanks to new regulations and new technology that's enabling the private equity asset class to move online. And I think that's a pretty transformational thing to happen to financial services, and not the type of thing we get to see every day. So to be a part of it is a really big deal, and to be able to educate you guys and get you to know more about what's going on is something I feel really fortunate to do. So definitely walk away from this recognizing that we're at the beginning of something really special, and hopefully you get to be a part of it sooner rather than later. So with that, tonight I'll kind of go through the KingsCrowd Genesis story, how I came to be here today with all of you. I'll tell you about the changing private equity landscape that we are seeing, and how that's kind of leading to this evolution and growth of the online private equity market. I'll tell you about what we're doing here at KingsCrowd to enable this new space to hopefully enable each and every one of you to be able to invest confidently into this new online private equity ecosystem. I'll tell you a bit about how we're building data-driven tools to enable this space. And then lastly, I'll kind of let you know, how to get started if you're interested in getting involved in investing in this asset class. And then I'll be happy to take any questions that any of you might have. So with that, just give you a little bit of background about myself for those of you who don't know me. I graduated from Boston College in 2014 and went and worked for a firm called LEK Consulting. Management consulting firm. I spent about 3 years there and spent the vast majority of my time doing private equity due diligence work. Prior to working at LEK, I didn't even know what private equity was. Ended up working for some of the largest private equity firms here in the United States and worked on over 30 deals conducting the due diligence before a transaction was closed. I would say about 70% of the time we were working for the actual private equity funds, and 30% of the time we were working on behalf of the company that was selling itself to a private equity fund. And if there is anyone that's on the call that doesn't know what private equity is, you basically have public equities, think Google, Facebook, any company you can invest in via your Robinhood or Merrill Lynch account, or TD Ameritrade account, whatever brokerage account you have. Those are publicly listed companies that are available to the general public. Everything that's not that is a private equity, to make it really simple. And so we were helping to transact, anywhere from $20 million companies up to $20 billion companies in the private equity markets. And what I learned during that time was that there are some real challenges in the traditional private equity space. And the biggest things that stood out to me were the lack of transparency and the lack of access in the traditional private equity world. And what I really mean by that is that from a transparency perspective, oftentimes we were working on behalf of these firms and we had access to terrible data in order to make these huge decisions about multi-billion-dollar transactions. Oftentimes about the company we were looking at, we couldn't get good financials on because of the lack of disclosures that are typically required in the private equity markets. And there really are no great data solutions for private companies here in the US that you can use to make informed investment decisions. So that to me seemed like a real inefficiency. And the other thing was when I saw a phenomenal deal come across my desk and I did all of the diligence on the company, I built the financial models, I did all of the research, I spoke to all the customers, I couldn't invest because I didn't work at the venture capital or private equity shop, and I wasn't an accredited investor, which is basically when you have $1 million in assets, not including your home, or have made $250,000 for at least 2 years in a row. So I started looking for solutions, and that's when I stumbled upon the Jobs app, which was created in 2012 to basically enable anyone to be able to invest in private equities online, which I'll get much more into. And I learned about all of these new platforms that were emerging that were providing access to really cool alternatives in the private space with really low minimums for non-accredited investors and anyone. And so I started a blog. And for 3 years, I got to know every major founder and CEO in kind of this new online investing and lending world. Everyone from, the Prosper and Lending Club CEOs to the Republics and Seed Invest of the world, really got to know all of the major players across all of the online private equity platforms. That in 2018 was acquired by John Fanning, who was the founding chairman and CEO of Napster, if you all remember Napster from back in the day. And he asked me to start a company in this new ecosystem. And so that was kind of the genesis and beginning of building KingsCrowd. It was to come and provide a rating analytics solution for this brand new space. And again, as I mentioned, I will get much more into what that all means. But to get started, I would love to tell you a little bit more about kind of the changing and evolving private equity landscape that's out there today. So as I mentioned, the private equity markets are really enabled by private equity institutions and venture capitalists, and on a much smaller scale, individual angels and investors. What's happened over the past 20 years is we've seen, because of the success of the venture industry specifically, funds have become much, much bigger than they ever were before. So, we went from, in the early 2000s, a typical VC fund might be $10 or $20 million, and now the median size is $80 million. And in the three key cities, Boston, San Francisco, New York, that represent, basically over 70% of all investments in kind of the venture capital market, are well north of $100 million. So that's created some real challenges for entrepreneurs because whereas, getting a 250 or 500K check with just an idea used to be a thing, now the average seed round is $2 million, and they're almost looking for Series A type metrics when they're making those larger investments. And it's simply because we have more dollars chasing the same number of deals, if not less. And so it's created challenges both for investors and for companies in this market. And what we're also seeing is that as we have, more dollars chasing these deals, companies are deciding to stay private longer. And that's leading to another challenge. So over the past 20 years, we have seen the number of publicly available companies that anyone can invest in be literally slashed in half. So now there's just less opportunities to invest in high growth companies via the traditional public equity markets. And the amount of capital that companies are raising prior to ever IPOing, went from, low 20 millions back in the late 90s, early 2000s into well north of $100 million today. And those companies' valuations are just exorbitantly higher than they ever used to be. It was pretty typical in the 90s, 2000s, even 2010s, where you could find companies in that 250, 500 million, at least less than $1 billion when they went public. And now what we're seeing is much fewer companies are actually going public when they're less than $1 billion in value. And oftentimes they're worth several $1 billion by the time they go public. But what that means for individual investors who don't have access to the private equity asset class is that we just don't have high growth equities that we can invest in anymore in the same way that we did have 30, 40 years ago. And that's created a real challenge. To give you an example, if we think about Lemonade, I'm not sure if any of you are investors in Lemonade. I know I invested. I've been following their story since they started about 4 or 5 years ago. And they're basically a new insurance technology company doing really phenomenal things. And it was funny, there was a late stage secondary platform only for accredited investors that was providing access to Lemonade a week before its IPO. And you could have bought up shares and it was at about $1 billion valuation. And when it went public, it was well north of 2 billion by the time, you could actually transact on Robinhood or any of the brokerage accounts. And so it just speaks to this fact that it's really hard to get in when the value is still there to see a ton of upside. And that's something that, we really do need to solve for. So, the main challenges, if I could sum it up with the traditional private equity market, and I want to be really clear that I don't think negatively of the private equity market. I'm simply asking, can we do better than what we have today? Is that we have these siloed networks. So it's often spoken about the fact that most of the funding goes through, kind of 3 key cities in the country. And so much innovation is just being left out of the pot. And frankly, just not being seen, right? It's not coming through the right doors and the right networks to be heard and seen. And we have poor data. We're making decisions in the private equity markets on really subpar data that just doesn't do the job of helping us to make really informed decisions. I remember a couple instances when I was working in private equity due diligence, and we would come up with these market sizes, and then we'd start seeing the reports they had from some of the other consulting shops or legal shops we were working with, and we would just see such disparities between all of our kind of market sizing and financial models. And it created real concern for everyone, and yet no one could really come up with the right answer except, oh, why don't we triangulate and average these things? But that could really lead to bad decisions being made. And so again, it's leading to that thinking, can we do better than that? The other thing that's been a real knock against the industry for many years is, if you look at the fees, if you're charging 2% fee on all of funds raised each year of a fund, which typically could last, upwards of 10 years, that ends up being a large portion of the fund, right? 5-10% of the fund could get eaten up in these fees, and then you have the 20% carry on top of that. But when you have kind of an opaque, offline, old industry, very much kind of like the banking industry was, 5 to 7 years ago or more, those things happen. And when the major institutions kind of control it, those are the types of things that happen. But if we can remove a lot of these barriers, if we can remove the limitations on who can invest, if we can remove the inability to actually know what's going on in private equity markets because we have financial disclosures, if we can make those networks go away and we can make it a much more democratized system that's open and accessible to everyone, well, perhaps we could really advance forward the private equity asset class in a really unique way that frankly resembles how most markets have adapted as technology has become more prevalent in all of our lives. So that's kind of, many of the drivers, right? The lack of access to high growth assets, the inaccessibility of the private equity markets, and sometimes the poor performance of the private equity markets that has led to this call to action back in 2012 to do something about it, to make the private equity markets more accessible. So back in 2012, the Jobs Act was created under the Obama administration, though I would say that this is probably one of the most bipartisan pieces of legislation that was out there and is out there, where basically it's supported by both parties. Everyone thinks this is good. If you're on kind of the more liberal side of things, it's about, social justice and democratizing access to capital and democratizing access to really great investment opportunities. If you're on the Republican side, it's about building great businesses and getting out of the way and allowing people to invest their dollars where they want to. And so it has a lot of really wonderful things for both sides that has brought together people working towards actually creating transformational change in the regulatory environment. So three key things came out of the Jobs Act back in 2012. And that was regulation crowdfunding, regulation A+, and regulation D506C. So if we could start with the first two, essentially what the first two regulations did, CF and A+, is it said, hey, non-accredited investors, which represent between 93 and 97% of America, based on which data you look at, should be able to invest in private equity companies. But if we're going to allow that, we need to protect both the individual investor and we need to limit the downside or the risks of any one company having a real impact on the market in a negative way. And so there are limitations on the company and on the investor. So for non-accredited investors under Reg CF, a company can raise up to $1 million a year from an unlimited number of non-accredited investors. They're allowed to advertise online and basically solicit for investment, even through Facebook ads and things of that nature, as long as they file all of the correct paperwork with FINRA and register on one of these FINRA registered platforms. In order to do that, if you want access to this new source capital, you have to provide disclosures around your past 2-year financials. They have to be audited. You have to provide bad actor checks on all of the key managers. You have to show anyone who owns more than 25% of the company. You have to show your operating agreement. You have to explain your use of funds. You have to provide an offering page that discloses the terms of the deal, how much money is being raised, and it goes on, right? And while in practice it's not overly burdensome, there's a lot of really good, rich information that's provided under regulation crowdfunding. And on the investor side, you basically have a limitation on how much you can invest on a yearly basis if you're non-accredited. It's $2,200 or 5% of your income per year up to $100,000, and then the rules change, becomes, I believe, up to 10%. And then if you're a couple, it's a combined. So there are different things you can do to have more cap space and how much you can invest on a yearly basis as a non-accredited investor. But there are almost 1,000 unique investment opportunities per year under regulation crowdfunding alone. Under Regulation A+, same idea, except companies can raise up to $50 million. This is much more like a mini IPO. And so there is an incredible amount of financial disclosures that have to be made. The auditing process is pretty extensive, and you have to continually provide those disclosures on a yearly basis. And so it is much more like being a public company, though you can raise a great deal more capital from a mix of these non-accredited and accredited investors. And then lastly, Reg D 506C is very much like your traditional accredited round, only that VCs would use or angels would use, except you can actually reach out to a broader network. You don't necessarily need to know these individuals. You can go online. You can, actually put the word out about your deal in a way that wasn't possible before with the soliciting requirements in traditional regulatory environment. And so what that's created is, this market where the regulatory environment is creating access from 3% of individuals in the private equity asset class to 100% of Americans. We're also seeing technology advance forward in major ways. So not only can you invest in private equities, which is really the focus of our discussion tonight, but there are so many other assets, and we'll get a little bit into what those look like. But it's because of the technology that's being created around fractionalization and securitization of literally any private asset. And what it's enabling is us to reduce the minimums from, you have to put $50,000 or $100,000 into an investment opportunity in the private markets down to as low as $50. And to think about how powerful that can be, if you were to have invested $50 in Uber back in 2008, that at the IPO would have been worth over $1.2 million. So imagine if Uber had said, you know what, for a Series B or a Series C, we're going to allow every one of our drivers the opportunity to invest in us. We'll let them know if you'd like to invest and own a small piece of our company, you can do that. And they could have all made a whole ton of money. And then lastly, on the data side, we now have this environment that requires data disclosures in a way that's never existed before. So we could actually understand what their cash flows look like and what their revenue growth actually looks like. And we can get a really in-depth view on how the company is actually performing so we can make better decisions, which is really, really powerful. So the question I get asked a lot is, all right, well, where are we at? How are things going? So it took about 4 years for the market to get started after the regulations were rolled out in 2012. They were fully enacted by 2016. It was a very slow-moving effort, though I will tell you that ever since everything's kind of gone live, things are actually moving at a much faster rate. The SEC is actually rolling out a whole new slew of legislation around this in what's supposed to be early or late fall, where they're going to increase the cap on Reg CF to $5 million. They're going to allow special purpose vehicles in this market. They're making it much more institutional as they recognize that things are actually going quite well in the market and we're not having fraud issues and we're having really good success and really good response from the market. So under regulation crowdfunding in 2019, we saw over $137 million raised. And I can tell you through COVID, we've actually seen incredible month-over-month growth of the market. And it's the same thing that we're seeing with like a Robinhood or really any investing right now, which is people are at home, they have nothing to do, they're looking for things to do, and this is an opportunity to look into something that's really interesting and new and different. And so I think this month we're probably going to see over 20 million invested and well over 200 million under regulation crowdfunding alone will be invested this year. Under Reg A Plus last year, over $2.4 billion were raised for companies. Under Reg D 506C, we've seen over $4 billion invested last year. And then in the late stage secondary space, we've seen over $5 billion last year be poured into various really late stage companies that are almost ready to IPO, and people are actually getting to buy up equity from former employees or investors in the company that are looking to cash out prior to an IPO. So what I like to always explain to people is that this is so much more than, some people know A plus, some people know CF, some people know 506C, some people know the secondary markets. No one is thinking about the entirety of the whole space collectively. And so what we're trying to do is help unify the space and help people understand that this is about the online private equity market. This is not about any one stage of company, any one specific sector, anything like that. This is about a comprehensive evolution of private equity to the online markets, which I think is really, really transformative. And I encourage all of you, and I'll list them out again later on, but to go and check out some of these platforms because they really are interesting. So the next obvious question is, well, can I actually find alpha in direct deal flow? You know, should I just get someone to invest my money for me via these venture capital firms or things like that? So first off, I'll hit you with two kind of rough data points, but just to kind of orient us to the market a little bit. So WeFunder, which is, I believe, the second or third largest kind of regulation crowdfunding platform out there. They actually started back in 2013, listing offerings under Reg D 506C. And they took their entire portfolio in 2013, all of the companies that were a part of that, and people had individual access to each deal, but they looked at the collective performance of all of those companies, and the net unrealized IRR is 53%. Seed Invest went and they looked at every individual who had a portfolio on their platform back in 2013, and they looked out to now, and the net unrealized IRR, the median net unrealized IRR was about 17%. And to orient you to what that kind of means, if we look at the median VC performance over that time, it was 11%. So these guys are performing well. These new online private markets are actually competing and doing a good job of what they do. And if you look at some of these names on here, we have some, you know, real kind of household names in the venture industry. Slack, Coinbase, Instacart were available on Funders Club. On Our Crowd, Casper and Beyond Meat. And actually, Our Crowd even had a slice of Uber. I forget if it was their Series B or Series C, but people who got in really early on the Our Crowd platform. Zenefits was a huge winner. Checker was another one on the WeFunder platform that became $1 billion unicorn. Excuse me. On Seed Invest, there's been a company called NowRx, which has essentially raised all of its money from the crowd, first under Reg CF and then under Reg A+. They went from basically an idea concept on a page, which was an on-demand delivery service for pharmaceuticals. Some of you may know them because they actually are out in the Bay Area, and that's where they've started. They went from kind of an idea on the page, you know, $8 million valuation for the first round, to their last round was a $60 million pre-money, and I think it ended up at over a $70 million post-money valuation with over $12 million in annual recurring revenue. So they've been growing through the roof and doing exceptionally well. And it's a company that's really poised to do some pretty big things in the on-demand kind of delivery service for the pharmaceutical space, and also been growing incredibly through kind of, you know, the COVID stuff. And this is an opportunity that you could have invested in as a non-accredited investor on these platforms. All of this is to say, yes, there are really phenomenal opportunities to invest in the private markets and find alpha that you wouldn't necessarily find in the traditional public equity market. And it doesn't stop there. So what I want to help people understand is that there's so much more than just private equity. We're starting with it because you want to be really good at one thing, right? You want to be known for it. You want people to trust what you're doing in that space. But then there's expansionary opportunities for us, but there's also expansionary opportunities for all of you to think about investing in other asset classes. And I have a whole bunch of names here, and I'll go through it a little bit. But if you want to invest in private debt, Cadence is doing some really interesting things. It's cadence.io, and you can invest in different debt funds and debt vehicles for pretty big corporations that are looking to raise money fast. And Cadence has a unique solution that lets you invest in those deals. If you're interested in real estate equity or debt, Ground Floor and Fundrise are phenomenal platforms. Fundrise basically provides almost like an e-REIT solution that allows you to invest into diversified portfolios of investments in both commercial real estate, multifamily, et cetera. And, you know, I've used a lot of these platforms. Fundrise, I think I've had 11 or 12% gain. On Ground Floor, you can invest in individual deals. These are basically home flipping deals where you invest in a 9 or 12-month home flipping loan for commercial home flippers. I've been using it for a few years, and I've had about I think a 9.5% return, annualized return, and that's over like 450 unique loans with as little as $10 invested in each one. Lending Club and Prosper provide the opportunity to invest in individual loans, and you could automate the process as well in consumer debt, which is a really interesting and unique asset class. And then lastly, there's other alternatives like Rally Road and Masterworks. Rally Road provides opportunities to invest in things like collectibles, anything from extremely expensive cars to wine to collectible cards like baseball cards that are really expensive, and you own a fractionalized share of the overall product, which is really, really unique. And Masterworks lets you own small pieces of very expensive artwork, you know, be it a Van Gogh or whatever it may be. And then Cedars and Crowdcube are two of the Western European equity crowdfunding platforms. Unfortunately, they're not accessible to the US right now, that we're hoping that regulation will change and allow people to be able to invest overseas as well. But all of this is to say is that there is an extreme abundance of alternative opportunities out there for you to explore and invest in. And it's a really exciting time to be able to kind of diversify into a whole ton of things, and you don't need a lot of money. Believe me, building my own company, I don't necessarily have a ton of money in the bank, but there's enough room to be able to do a little here, a little there, and see really nice returns. So what's our role in this market? Well, at KingsCrowd, I'd like to orient people to understand what we're up to by explaining the public equity markets. So between the individual and marketplaces in the public markets are a few key things, right? So you have NASDAQ and you have New York Stock Exchange. That's where companies actually go and publicly list. That's where Google and Facebook, that's where you go and you list your company. But an individual doesn't go to NASDAQ or New York Stock Exchange. And most individuals, I would imagine, don't even know that NASDAQ and New York Stock Exchange really exist. What they know is that they invest in companies out of their brokerage account. They go to their brokerage account and they're probably finding reports from Morningstar, and they're probably finding some data from Bloomberg. And then they're going and they're looking at, different resources, right? And under rating and analytics, you could probably add in research like Wall Street Journal and the Motley Fool and whatever financial publication you might subscribe to and utilize. But you have tools at your hand to basically take the marketplaces out of the equation, find all the research that you need, and be able to execute your investments in one place and hold them all in one place in a really simplistic way. Well, in this new online private equity market, nothing exists between the individual and the marketplace. That gap still exists. So you're having to go to every marketplace, create an account, execute the investments, and there's no one out there to help you kind of maneuver the market in an efficient way. And that's what we're trying to solve for. So at KingsCrowd, what we do is we aggregate the deal flow from across every one of the marketplaces, from early stage markets like Start Engine and WeFunder, to the growth stage markets like Our Crowd and Funders Club, to the late stage markets like Shares, Post, and Forge. We aggregate all of the deal flow, well over 1,000 deals per year available to an individual. We aggregate every publicly available data point about those organizations. And on top of that, we overlay 115 proprietary rating data points about each and every one of those organizations. And what that enables us to do is create a benchmark rating scoring system for each and every one of these companies that's available to you to invest in. The whole idea here is to essentially provide one purview into the entire online private equity market and provide context by which to think about the opportunities that you can invest in. So we're not necessarily saying, hey, because it's a 4 or 5, that's definitely the answer. What we're doing is we're cutting out all the noise, those 1s and 2s and 3s that are just kind of men and have all sorts of issues. You can finally focus in on the things you care about and filter and search on all the key criteria that really matter to you as an investor. And you can imagine over time, as we build out these data sets, this is the first time in the private equity markets that we have things like financials and we have real data about the companies. And on top of that, we have our proprietary rating system where we're looking at every company in the exact same way on actual data criteria, not just subjective criteria. And by doing that and quantifying everything that we can, what it enables us to do is essentially watch how these companies perform and eventually build predictive analytics around that and create even index funds where basically you have one-click investing to have diversification across the entirety of the online private equity ecosystem, which is a really, really unique way of providing easy diversification into a high-growth asset class with not a lot of effort, which currently does exist, without a solution like KingsCrowd kind of sitting in the middle and enabling the space forward. So what does our product set look like? We provide, basic analytics on each and every one of the companies around how much money they're raising, what industry they're in, their financials, the terms of the deal, the type of security they're using. Then we have our ratings. So every company gets their 1 to 5 score of how well they perform on all of the key dimensions of the business. And then lastly, we have kind of our long form research or analyst report. That's for those companies where we're really interested. We'll dig in further and do a deep dive on the organization. We also provide a portfolio management tool. While we have no plans to become a brokerage account, we do have plans to partner and work with brokerage accounts, and we're actually making some really phenomenal progress there. But what we have created is basically a mint.com-esque solution. It's free for anyone to use, and it essentially allows you to track all of the companies that you're investing in on these various platforms in one place. And one of the cool things that enables us to do is A, see what everyone's investing in and see how all of these different portfolios perform, and B, help people understand the performance of their portfolio as we add in future valuations based on when they have invested to understand how their returns look. Excuse me. And then lastly, we have industry level market analytics. So in trying to help people understand the opportunity that exists here, you really need to orient them to the entire market that exists. And so what we're doing is we're providing industry level analytics based on all of the data that we're collecting so that you can come in one place, kind of get a better conceptualized understanding of what's actually going on in this space, how much money is being raised, how much money is going into different industries, where is it going, what types of companies are going into, and give you a better sense of different trends in the market, which again is just not a tool that really exists in this market at the moment. So when I say underlying market current here, I've laid out kind of a business model slide. And the reason that I did that is because of the excitement and interest we're seeing across these different lines of business. So 2 years ago when I started this company, we really went after the B2C angle. And the reason we did that is because end of the day, it's the easiest place to kind of suss out the idea, find if there's a level of interest in what we're up to, and see if we could drive some demand for our product. And it's kind of a low barrier to entry to put something out there and start testing with people. But what's happened over the past couple of years is we've seen an incredible amount of interest from major institutions. And to be even clearer, over the past 2 or 3 months, we've been getting cold calls from some of the world's largest brokerage companies out there who want to utilize our product and are talking about how do we enable a private equity solution in our brokerage accounts. And the reason why all of this is happening is because of the Robinhood trends and the zero fee trading. Everyone in kind of the brokerage world is saying, what's next? What do we do next? How do we monetize our platform and make money again? Well, we need to provide a new asset class. and they see the opportunity to be in the private equity asset class as the way to go, as an expansionary opportunity. But in order to do that, they need a third-party ratings provider who's independent, who can provide kind of the data and analytics layer, and not make them, the recommendation engine as the broker, which they don't want to be in. They want to be providing a comprehensive solution and provide that outside context to their investors and not have that be on them. So it's a really unique opportunity that we're in to be able to service these major, 2 of the top 5 brokerage accounts in the United States are really actively seeking how to work with us and enable a solution like this. And then on the B2B front, I've been really surprised at the number of multi-billion-dollar multifamily offices who have come to us. We've also had a ton of interest from RIAs and wealth advisors also coming to us and asking us the question, how do we provide this to our clients? We want to provide this asset class to them, but we need help, we need support. And that comes in the form of research, and it comes in the form of rating reports and things of that nature. And the main reason we're hearing that is because essentially they're servicing younger clientele, and that younger clientele is asking for things like social impact investing, and they're asking for direct deal flow, and they want to invest in female founders and minority founders, and they want to be in things that traditionally their parents were not in. And so they can't just put them in a traditional VC fund. They can't just put them in traditional stocks. They have to find something new. Then they see this avenue as a real opportunity for growth. And so we're really excited about, what we're seeing there as well. But again, all of this is speaking to this underlying current that's been coming. When I started 2 years ago, it was basically retail investor early adopters that were into this. And now we're seeing these major institutions start to show real interest. And I think we're kind of on the cusp of turning a pretty big corner. We ourselves as an organization, we've raised $1.2 million from 2,100 investors online. About 25% of our company is now owned by individuals. And the cool thing about those 2,100 investors is we have people who wrote $100,000 checks and are, founders of billion-dollar companies. And we have individuals who are friends from home who wrote $100 checks and everything in between, which I think is really, really cool and really unique. We're also one of the most traded secondary equities in the private equity world because we're on the first platform that has a secondary exchange for individuals to be able to buy and sell secondary stock in private equities. And so we probably see, 50 or 100 shares of our company trade weekly, which I think is really unique. And we're up by about $1.50 from where we raised our last round of funding. We've grown to about 366,000 customers or subscribers, 23,300 paying customers. We have about 805,000 annual recurring revenue. All of this is to say there's a genuine interest in what we're up to. People are engaging with what we're doing, and they're finding a real value in the service that we're providing. So our long-term vision, kind of going back to that slide that I showed a little bit earlier, We are building a global Morningstar of the online private equity markets across investment ratings, predictive analytics, and index funds for all of these assets. We're starting in private equity. We want to own that space, but from there it's private debt, real estate equity and debt, consumer debt, other alternatives, and global expansion. It's, as I mentioned, the beginning of the birth of a multi-trillion-dollar market opportunity. So one of the big questions that I often get asked is, okay, can you explain a little bit more about, how your ratings work? And believe me, if anyone has interest in what we're up to, I am more than happy to share more and spend time with individuals offline, and we'd have our director of investments also get on the phone call and explain more about how our models are actually working. But I'll just give you a quick kind of overview. 5 key areas that we look at for each company. This is our early stage rating, so all pre-seed and seed companies. We look at things like price, which is valuation, security type. We look at market size, market growth rate. We look at team. We look at differentiators, and we look at performance of the company. Within each one of those, there's key sections that we look at, and they're all quantified items instead of thinking about the subjective nature of startup investing. So for instance, on team, we look at what's your relevant industry experience. Literally, we ask the question of, and we go and do the research on, if you're starting a real estate tech company, how long have you been in real estate? Have you spent time in that? Which can be incredibly important. And that gets, basically vetted out against every other company out there. So if you spent no time in a market and someone else spent 10 years time in their market, they're going to get a better performance on relevant industry experience. We look at, do you have previous startup experience? Literally, have you built companies before? Have you spent time at startups? Because it is so important to have that experience. And then we look at, have you had any exits? And all of these criteria get benchmarked against every other company that's out there that's available for investment. So again, using this as a market screening tool to understand, okay, how does this company compare against every other company that I can invest in right now? And why does it rate on those criteria in the way that it does? In addition to the key rating elements, we also provide attributes. And these are just things you might want to search on or understand a little bit more about. It doesn't count for or against the company. It's much more about understanding what it looks like. So things like founder's age, 30% of all companies who are raising capital right now are between the ages of 20 and 34. Just so you can understand what this company looks like against the others. How many founders are there? How many employees do they have? Have the founders worked together before? And we even have tags, and tags are basically interest areas like female founder, minority founder, famous founder, whatever it may be, more subjective criteria, but just to help you understand and find the things that you want to find as you're thinking about making an investment. So what do our early data results look like? Well, we've rated 600 companies since January when we began our effort to build out our rating system. About 60,000 data points have been collected on these companies. Probably almost less than 5% of companies get a 5, which is the best score. The vast majority are in kind of that 1, 2, and 3 category. We actually think that's a really good sign. We've also done tests of seeing how does a subjective rating, how our analysts think about an opportunity as being bullish or bearish or neutral, compare against how they're actually vetting out in terms of a quantitative data point. We're finding we're about 80 to 85% accurate in terms of how those correlate. Now, that's just one data point to understand, how does this model work versus our data-driven approach. But it's really interesting. We're starting to get some very, very interesting insights. And of course, over time, as we continue to build this out and have thousands of companies, we're going to learn some very, very cool things. And then in late May, early June, we launched our portfolio product, as I mentioned earlier, that lets you track all of your investments in one place. It's still in beta, but we've had about $5.9 million tracked of investments, all via Reg CF deals. We've had 8,295 unique investments tracked within these portfolios across about 1,000 portfolios. And on average, people have about 14 investments in their account. So these are very active, engaged investors who are really utilizing our product and are really utilizing the market. And it speaks to this dynamic of people are working to diversify their portfolios and build interesting portfolios for themselves. So over time, our plan is to basically apply machine learning on longitudinal data studies, looking at things like valuations in the future, exit data, company reporting around their financials, which is required under A+ and CF, look at secondary transaction, or look at what are people paying in the market. And eventually this is going to enable us to build some institutional-like ETF funds for this space. So for those of you who have found this interesting, and have enjoyed hearing more about what we're up to at KingsCrowd. I wanted to provide a little rundown of how you can get started, and I'm happy to pass around this deck if anyone would like. We are providing a 20% off coupon for everyone on this call tonight for our pro annual membership with coupon code New Frontier. You could go to kingscrowd.com and check out. There is a section that says have a coupon. You click it and put in New Frontier. You'll get 20% off our pro annual subscription. And when we launch our ratings platform, which will include those 600 companies that have already been rated and everything we're rating on a daily basis, you'll get 3 months access to it when it launches in the second week of August or so. And then the other thing I would encourage you to do is go and check out the platforms. A lot of people, they hear this, they think it's really cool, and then they don't go and engage at all. Or maybe they come to our platform and they still don't fully get it. I really do encourage you to go to these different marketplaces and check out what's going on. I think oftentimes if you hit a market like Forge or SharesPost or an Our Crowd or a Seed Invest, and you see something that you actually have heard of or know about or a space that you're really excited about, and you go, oh, really? I can invest in something like this? It starts to really pique the interest and it gets you more engaged. So I definitely encourage you go and check out a lot of these platforms. They're pretty easy to find. Happy to send any URL links if helpful. And then lastly, we are doing a round of funding at this moment. We're working towards a much larger round of funding in the fall. So we're doing a small round of funding right now. Mostly this is coming from current investors. We've raised about 200 of this 500 in the past few weeks. And we're basically investing everything into product development and business development to enable our Series A in the fall to winter of 2021. And basically in terms of the deal that I'm happy to share and anyone can reach out to me is an uncapped convertible note, 20% discount on the next round, 5% interest, and a $5,000 minimum to be a part of this current round. It is online. It is only accredited at the moment. Our next round of funding will be for non-accredited as well, but at a higher valuation. And if anyone would like to contact me, you can hit me at chris@kingscrowd.com. Thank you.
Wow. That was a good presentation, Chris.
Oh, thanks.
Yeah, I enjoyed that. So feel free if, so it's Q&A right now. So if there's anybody with follow-on questions with Chris, feel free to just type in a chat and then we'll address those.
Actually, Roland, several questions did come in already.
Okay, good.
So I'll read them aloud, and Chris, feel free to take a stab at answering them or asking for clarification. But
happy to.
All right. So James is asking, I'm an angel investor, and one of the problems I've had is illiquidity. What options do these new online private equity solutions have for realizing liquidity on an investment?
Great question, James. So as I was just mentioning, the platform that we've utilized is called netcapital.com. And NetCapital has actually built a secondary market. So if you invest your money on the platform netcapital.com and any of the companies that are available there, you then have the opportunity after holding for 1 year if you're not accredited and less if you're accredited, you can sell those shares. You set the price and you say, okay, I'm going to sell 1,000 shares at $3, whatever it is. And then if there's a willing buyer, you get connected and you can sell those shares. And now to people's question around, well, how much liquidity is there? I'd say it's still limited. But what I would also say is it's growing pretty exponentially. And we're seeing for our own stock, we're trading, almost every other day at this point, where people are buying up shares. And whenever we put out an update, people get excited and they buy more shares. So there are solutions being built. Start Engine is another one. They say within the next 6 months or so, they'll have a secondary platform. And then platforms like Forge and SharesPost have actually begun to talk about creating primary platforms that they can then offer secondaries on once you've held those shares for a period of time. So it's coming. The storm of secondary markets are coming. And if you utilize these platforms, oftentimes I think there will be liquidity solutions going into the future.
Very nice. Very nice. I've got three more. This is from Seishu. Does your solution provide an API for third-party fintechs to partner with you and marry the investors to the funds through enablement on their platform?
So we've actually been asked about this a few times in the past few weeks. And so we are working to build out an API solution. And if you have interest, please do reach out to me directly and I'll connect you with our CTO to begin work on that.
Great, great. Question from Holly. Holly says, this is a fascinating concept, company, and presentation. Is the company building an ecosystem to accelerate growth? And who might be the candidates for partnerships?
So yes, I would say our whole role in this ecosystem is to accelerate growth, right? So the problem with only marketplaces existing is one, fragmentation, and two, an inability to contextualize what all of these markets means for an individual investor. Where do I go? What do I look for? How do I think about an early opportunity versus a late opportunity? It's so complex. And so we're trying to simplify all of that, bring it into one universe, and make it easy and accessible to maneuver. So really that's our whole job, is to make this market something that's really accessible and simple and easy and all of those good things. So that's how we're encouraging kind of the growth of the market. And then we're looking to partner or, be the customers or have customers that are major financial institutions, be it family offices, wealth advisors, RIAs on a more traditional sale where we're literally just selling you our service, or more of a licensing partnership with major brokerage houses and institutional investors who actually want to provide access to this asset class to their end customers.
Excellent, excellent. Another question from Ross. This has been an excellent presentation. Congratulations. He's asking if I'm in the lending business looking for debt capital to administer into the market in the U.S., could you assist in raising debt capital or only equity?
So to be really clear, our role in this space is to be kind of the third-party rating and data layer. So we're not going to raise capital for equity. We're not going to raise capital for debt. That's not our role in the ecosystem. However, what we do is we look at the entire landscape of everything that's out there, right? So if you're looking to deploy capital into debt deals, or you're looking to raise capital for debt deals, some of the places you might want to go check out are cadence.io. I don't know what type of lending exactly that you're trying to do, but there are platforms for everything now. And there's a good chance you could find one that can meet your needs.
Great, great. Question from Joe. How much does your service cost after the trial offer?
Yep. So our kind of pro service is $20 a month or $200 for a year. And that's essentially more of our qualitative analyst reports. And we have founder research, and we have education, and we have all sorts of resources there and free tools as well. The Merlin rating product that I was mentioning earlier is actually a $75 a month product. It'll be $750 a year. So after the 3-month kind of free trial of utilizing it, it would be $75 per month.
Great, great. And I think one last question from Phil. Aren't the best deals still going through the private channels? Which deals don't interest private channels related to crowd available channels? So I think he's asking if the best deals
basically like traditional PE, are they still seeing the best deals? So what I like to explain it, it's kind of funny. I was trying to think about what is the dynamic that exists in this market. And a lot of people say, well, I went on this platform and I saw this really dumb deal. It's like, yes, there are dumb deals everywhere. If you're a venture capitalist, you spend about 90% of your time looking at really dumb deals, right? And so in every market, there's a whole bunch of bad deals and there's very few really good ones. And this market is just like all the others. What I would say is the number of really exceptional deals in this market is just as much as the really exceptional deals in a traditional private equity world. And I can even tell you, I gave a few examples earlier of really phenomenal deals being offered up on these platforms that all of the biggest VCs have wanted in on. But I can even tell you, listening to founders, we've seen this kind of evolution of more and more founders who have been burned by the venture market. One guy sold his company for I think, over $100 million. He got a pinball machine out of it because they had diluted him down to nothing, right? And he was like, never again. And so he's raising for his AI company now via these channels, and he's doing exceptionally well. And so you could find really, really terrific deal flow here. You could find really bad deal flow here. And I would say the exact same thing exists in a traditional private equity channel.
And I think that's where your tool, your services can really help kind of provide some, insight into the deal flow.
That's exactly right. We want to help you figure that out and maneuver the market and find those good deals much easier.
Very nice. Folks, any other questions? Feel free to chat. to Roland, Chris, or myself. But Chris, that was all we had so far. But Roland, do you have any questions coming to you?
Yeah, the only one I have is, Chris, if folks want to get a hold of you, what's the best way for them to get a hold of you?
Yeah, so email I think is the best, and then I'd be happy to set up time to chat with you on the phone or over Zoom, and that's chris@kingscrowd.com. And as I mentioned earlier, Roland, if you want me to share the deck with you or anything like that, I'm more than happy to pass it around.
Sure. I'm suspecting that folks will want a copy of the deck because I've gotten, oh yes, somebody's already said, yes, please share the deck. Exclamation.
Happy to do it. That sounds great. I'll send it your way right after this.
Okay.
Very, very nice.
Awesome. Well, if there's no more questions, Chris, thank you so much. And I typed, just for everybody's information, I typed Chris's email in the chat over here in Zoom. So chris@kingscrowd.com if you'd like to get in touch with him. And then we'll also send out the recording and the deck shortly.
Yes.
So.
Excellent. Well, thank you all for having me tonight. It's been a really wonderful discussion. I appreciate the opportunity to share it with you.
Thank you, AAII, and all the members. So thanks, Roland. We'll see you in about a month.